Hey, what's up, my friend? Welcome back to Ask Rainer, right? Today is episode 2, and I've got a question from Jay, who asked me, Hey, Rainer, how do I know when is the best time to exit my trade? Okay, so in today's episode of Ask Rainer, right, we have a question, or rather, I have a question from Jay, who said that he has a difficulty, right, knowing when is the best time to exit his trades. So in today's video, I'm going to talk about this, right? When is the best time to exit your trade? So before we can talk about it, right, exiting your trade is primarily a function of what you want to achieve as a trader, or rather it is a function of what is your trading approach. Let's say, for example, if you're a swing trader and another one, let's say a position trader, right? These two types of trader, they have very different trading methodology, right? As a swing trader, you're typically trying to capture swings in the market, right, to have more consistency in your trading. For a position trader, right, who is also known as a trend follower, you're typically trying to capture trends in the market. So since both of them have different objectives, right, it would only make sense that you would have different exit approach. Okay, so I'm going to share with you a couple of ways to exit your trade, right, in this video, right. For swing trader, number one, the way you can exit your trade is at highs and lows in the market, right. What I mean by this is quite a simple, right? Like, let's say, for example, the market is, say, this is an area of support, right? You go long at this area of support, right? So if you're going to capture just one swing in the market, you can just exit your trade as price approach this area of resistance. Why do you want to do this, right? Because remember, as a swing trader, your objective is to capture a swing in the market, and this is precisely one swing in the market. The reason why you want to exit over here, because you know that this is an area of resistance. There could be potential selling pressure to come in and push price lower. So this is why that as a swing trader, you just want to take one swing in the market. And I would say highs and lows in the market, all right, are good areas to capture a swing in the market. Second option you can consider is to use what they call a Fib extension to actually exit your trade, right? A Fibonacci extension. I would say this is useful when the market is trending, right? Because if in an uptrend, right, the highs tend to get taken out, right? So you may be thinking, right, as a swing trader, I may not want to exit at this high over here because the market may push higher before it retraces. So where is a good level? Somewhere over here. Where is a good level somewhere over here that you can actually take a swing in this market? Where is a good point, right, where you want to exit your trade, so-called to maximize your profits, right, instead of just exiting at the highs? So this is where a Fibonacci extension would be useful. So let me explain to you, right, using this chart of Euro New Zealand, right? You can see that this chart over here is clearly in a downtrend, right? Series of lower lows, lower lows, lower lows, lower lows, and lower highs. So that said, right, let's say, for example, you are short somewhere, say at this high over here, right? You're short at this high, and you don't necessarily want to exit your trade at this low. I'm not saying it's wrong, that is possible, but since you know that this is a downtrend, right, this low has a good chance of actually breaking. So you're wondering, where is a potential level that you can exit your trade, so-called to maximize your profits as a swing trader. So this is where you can use what I call a Fib extension, right? This is just a very simple Fibonacci tool, but I've actually modified it to use it as a Fibonacci extension. Okay, so what you want to do is just pull out this tool, Fibo properties, you click on it, right? I've actually added additional 3 more levels, which is this one over here. The 127, the 162, and the 200. Why 127 and 162? Well, this is basically Fibonacci numbers, right? You have 27% retracement, 62% retracement. So this is just simply the inverse of it, right? So the level you want to put in here is minus 0.27. Description, you can put it 127. This one over here is minus 0.618. Description is 162, right? To be more precise, it should be 161.8, but I just rounded it higher. And this last one over here, right, -1, description is 200. So this basically means, right, this 200 means is basically a copy paste from the highs and the lows. So let me explain to you what the 200 means. So this over here, right, from here to here, you copy this portion over here and you paste it lower, it will give you this 200 extension. Okay, how you get a 127 is very simple. This distance over here, right, let's say this distance is say let's call it 1 meter, right? You add another 27%, you get 1.27 meter. Let's talk in terms of, distance, right? So you get 127 extension. And similarly for the 162, you add another 0.62 meter, you get 162 meter, right? And this is the 162 extension. So this basically the highs and the low, the swing high to the swing low which you've drawn, right? The multiplier of this, right, will give you the respective levels accordingly. So this is basically how the Fib extension works. Okay, so that's a quick one, right? Now I just want to share with you, right, on how to actually use that tool to exit your trade as a swing trader. So what you want to do is, let's say for example, you went short somewhere here, right, near the highs of resistance, right? And you're thinking, where is a good level, to possibly exit this short trade? What you can do is you can take the Fib extension tool, draw it from the swing high to the swing low, right? This is the swing high to the swing low, right? And you can see that these numbers over here, the 127, the 162, and the 200 are appearing, right? This is the 127, the 162, and the 200. So these are all the respective levels here, here, and here. So I would say these are possible levels that you can look to take your profits, right? I can't say which is the best level to exit your trades, right? Whether is it a 127, whether is it a 162, or is it a 200? Because the truth is, there is no best Fibonacci extension level, right? So these are, these open up to possibilities on how you want to manage your trade. Maybe you want to manage, you take half at this level, another half over here, or maybe you take everything at the 127 level, or maybe you take one third. That, the possibilities are endless, right? It really boils down to, what you're trying to achieve from your trading, right? What are the decisions that make you feel comfortable as a trader, right? But nonetheless, the main thing I want to share with you is to, how to use the Fib extension tool, right? To actually, capture a swing in the market, especially when the market is trending, when it tends to, break above the highs or below the lows. Okay, so this is the Fib extension tool, right? Go and play around with it, right? I believe you'll find this useful. So now, back to our second approach, right? Position trading. So earlier we talked about a swing trading approach, right? You can exit either at the highs or the lows, or using the Fib extension. That's for swing trading, right? Swing trading. What about position trading now, right? Trying to capture a trend. Again, there are numerous ways to do it, right? But I'm going to share with you two very practical ways, right? Moving average is one, and the second one is what I call structure of the market, right? Trailing your stops using the structure of the markets. So position trading, right, is very different from swing trading because you are not going to have a fixed target profit in mind, right? Instead, what you're going to do is just to simply trail your stop loss as the market moves in your favor, right? And two ways to do it is using moving average and structure. So you can see here, right, back to this slide, let's say this is the chart of dollar Mexican, right? And you can see that this market is clearly in an uptrend, right? So a very simple way to actually, to capture this trend, right? Let's say, for example, you long the break of this highs and you're wondering, how would you actually, manage to capture a big trend like this? So again, right, as I've mentioned earlier, you can use moving average, right? For example, let's say using the 50 period moving average, a blue line. You can see over here, right, that if you use a simple moving average, if you use this moving average, this is actually the 50 EMA, right? Alright, and you choose to exit your trade only if the market closes below the 50 EMA, right? This would have put you in this entire move, right? You would have caught this entire huge move towards the upside just by trailing your stops using the 50 period moving average, right? Some very common moving average that traders use are the 50, right, the 100, or the 200. And again, right, there is no best moving average out there, right? It really depends on, what type of trends you want to capture. If you want to capture the really long-term trend, then you can trail your stop loss using the 200 period moving average, right? You would capture, really long-term trend. But the downside to it is that, you would have to risk to give back large open profits because, right, of the way that the moving average is less responsive because it's a longer time period. So you would risk giving back a large chunk of open profits. So that is the pros and cons to it, right? You would tend not to, get faked out so easily, but you would give back a large chunk of open profits. So for a lower period moving average is just the opposite, right? You will tend to get, faked up more easily, right? But you won't give back so much open profit. So as I've mentioned, there really isn't a best approach to it, right? It's really, finding the one that makes the most sense to you, right? So this is for moving average. And lastly, what you can do to trail a stop loss, right, when the market is, when you want to capture a trend, is to use what I call structure of the markets. In an uptrend, right, the market consists of, higher highs and higher lows. Okay, so since you know that this is a very basic structure of the markets, you can actually use this structure to trail your stop loss. So what I mean by this is that since in an uptrend you're going to get higher lows, what you can do is just trail your stops below the previous swing low, right? So let's say, for example, the market broke out of this high at this point in time, right? It broke out of the high. What you can do is you can trail your stop loss at this significant swing low over here, right? You wouldn't really want to put it just below the low. Maybe give it some buffer, put it somewhere here. Okay, and as the market, break out of these highs as well, you can trail a stop loss and put it maybe somewhere here. And as it broke out of these highs, you can trail a stop loss below this low, maybe say somewhere here, give it some buffer. As the market broke above these highs, you can trail a stop loss, right, if you want to reference from this low, right, give it some buffer, maybe over here. And as the market broke above these highs, maybe you can reference from this low, right, give it some buffer, maybe say still around this level, somewhere here. Okay, or if you want to trail your stops tightly, you can even reference it from this low and maybe give it some buffer somewhere over here. So you can see that this is another approach, right, to trail your stop loss using the structure of the markets. Okay, so let's do a recap, right, into what we have covered today, right? So as I've mentioned, right, the best way to exit your trades is that there is no best way. It really depends on your trading approach. So we talk about the two approach, right? Number one, swing trading, right? You can exit your trade, right? I share with you two possibilities. Number one, the highs and lows are good areas to look for to exit your trade, right? Especially if the market is in a range, right? Targeting at the next highs or lows are, possible scenarios that you can consider. Second thing is that if the market is, let's say, if it's trending nicely, right, you may want to use a fib extension, right, to exit your trade. So this sort of like give you a more meat in the move that you are, trying to capture the swing, right? I shared with you, like, you can use the 127, the 162, or even the 200 extension, right? There is nothing magical about these numbers, right? They're just simply Fibonacci levels, right? And the 200 is just simply what they call what's the term for it? Price pattern projection, right? For example, if the market has moved, let's say, a distance of 100 pips, you project that 100 pips into the future, you get another 100 pips. So let me put it this way. Let's say if the market is in a range, right? You take the highs of this range to the lows of this range, you copy and paste lower, right? This 200 extension would actually, project where this breakout may potentially terminate at, right? So this is what the 200 is for. Okay, so that's for swing trading. Then we talk about position trading, right? I share with you two ways to exit. Moving average is one, very simple. You can use 50 period moving average, 100, 200. It's really up to you. Or alternatively, you can use structure of the markets, right? You know that in the trending market, you have higher highs, higher lows. You can use the structure of the markets to trail your stop loss. Okay, so I hope this gives you an insight, right, into how you can actually exit your trades. Right, again, there is no best approach, but hopefully this gives you an idea, right, on how you want to do it based on your own trading objective and based on your own trading approach. Okay, so with that, right, I hope you found this episode of Ask Rainer useful. If you've enjoyed it, feel free to hit the subscribe button and the like button below. And if you have any comments, right, let me know in the comment section below. With that, I wish you all good luck and good trading. Talk to you soon.